One of your big lines, Andy, is to never to buy when you're trading options. Never buy. You've told me always sell. Now it's come to my attention that recently you've bought an option. So explain yourself. What's going on?
So, yeah, selling options, it all comes down to probabilities. And as most of the people that watch these videos know, and some that don't, I'll kind of go back to, my original, like my thinking when it comes to options. So I use, just basically starting from scratch, I use the RSI Wilder over various time frames to gauge whether something is overbought or oversold. If something's oversold, I will sell what's known as a bull-put spread. It's a credit spread. It's a type of credit spread. If something's overbought, I will sell what's known as a bear call spread. And typically what we want to happen is something is oversold, there's mean reversion will typically happen, and we'll see a short-term fade of that current trend, which in that case, if it's oversold, it would be lower. So basically, we're expecting if we sell a bull-put spread, that asset or that ETF is going to move higher over a short period of time. However, by using a bull-put spread, we can go, let's say something's trading for $20. We can buy or sell a bull-put spread at maybe $18 or $17. So that gives us that margin of error. And that's why we do these high probability trades, because we don't necessarily want to guess the direction of a trade.
So far you've sold something.
And that is 99% of everything that I do. However, the speculator part of me, which is a very small part of what I do, very, very small, is occasionally I'll buy an option. Now, one of those options that I recently purchased was in gold, GDX actually. And GDX is trading for roughly $22. And the reason that I did that is because it's become so oversold that typically when we see these types of oversold readings, when they're this extreme, and especially over all the various time frames that I follow, we're going to see a move in the opposite direction, that same fade, that same mean reversion over the next 1 to 3 days. And that's how I'll play it. So in this case, we had spoken about this earlier, was I actually sold a bull put spread, and that was one separate trade. And then I actually purchased very few contracts. And that's the other thing that I want to make clear, is that this is an incredibly small position size, because it has the chance to make a decent amount of money. And when I say a decent amount of money, maybe 30, 40, 50%. And that's typically a lot higher than what we're used to seeing when we sell options, particularly high probability options that have a probability of success of roughly 80%. So in this case, I'll buy an option. Now, what most people do is will buy an option that's out of the money with, say, a delta of 30, 25, whatever. Now, what's happening is, and they'll buy it during the front month, meaning we're in that June cycle. We have a few weeks left until June. If we go out to July, we have 50 days. I typically will go out 3 to 4 months. Now people are like, well, why would you want to buy a more expensive option? I don't want theta decay to have any bearing on my that option that I purchased. Even though I'm only going to hold on to it for a week, maybe 2 weeks, I don't want it to have any bearing whatsoever. So that's why I go further out. I'm paying a little more for it, but at the same time, it's not like I'm going to allow that options contract to go to zero. There's risk management in play. So basically, I'm playing this mean reversion when I do purchase an option, and it has to be incredibly oversold. I'm talking about, anything below 10 is considered very oversold when it comes to RSI. Anything above 90, 95 is considered very overbought. When something hits below 5, then it's like, okay, now we really want to start selling some options. But in this case, GLD was 0.2. So when something gets below 1, that's when, and especially below a half, 0.5, then it's like, okay, something's about to happen, and I'm going to take on a very small position. I'm going to sell options, but at the same time, I want to buy a couple contracts also. And again, I can't emphasize this enough. When you buy options, you want to do it in a very, very small way, because it's a highly risky trade. But again, if you have a stop loss in place, and you can put those stop losses in place immediately, and it's very easy to do when you're just buying a contract as opposed to doing it on, say, if we're selling a spread or something like that, even though you can. I tend not to do that. I set mental stops, but I've also been doing this for a long time, so I'm a little more disciplined than, let's say, the new investor. So it's probably not a bad idea for a new investor to have a stop in place, but that's the only scenario that I ever buy options, because like I've said numerous times, I don't know where the market's going over the next 1, 2, 3 years, but I do know over a short period of time, particularly when these RSIs line up, and this has happened 6 times in gold over the last 2 years, and each and every time we've seen GLD pop 10 to 15%. So, and I'm willing to take that chance on a very small amount of contracts.